Greetings, everyone, and welcome to our debate on how DeFi affects the inclusive finance community. I am Alicia Galindo, a professor and researcher at Tecnológico de Monterrey Business School. I'm thrilled to be part of this panel that will delve into the advantages of decentralized finance, DeFi, and its crucial role in financial inclusion, as well as its risks. First, we will be discussing the benefits and then the risk of DeFi in the financial industry. One of the major benefits of DeFi for the final customer is the ability to have more control over their finances. With DeFi, customers have access to a decentralized financial system that is not controlled by any central authority. This means that customers can carry out financial transactions without relying on any intermediaries. However, it is important to note that there are also risks associated with DeFi. This is the second part of our debate. Some of the risk factors include smart contract vulnerabilities and hacking. Customers need to be aware of these risks and take necessary precautions while using DeFi. So, we will address and answer the following questions. Which are the benefits of DeFi for the final customer? And which are the risk factors in DeFi? So let's get started with the first point of view.
Hello, I am Sebastián García, adjunct faculty in the Accounting and Finance Department, Business School at Tecnológico de Monterrey. Today, we're diving into the fascinating world of decentralized finance, commonly known as DeFi. We'll be exploring how DeFi is affecting the inclusive finance community and the benefit it brings to the final customer. So let's get started. The inclusive finance community aims to provide financial services to everyone, especially those who have been unserved by traditional financial institutions. With DeFi, we witness a paradigm shift in the way financial services are being offered. But how exactly does DeFi affect this community? DeFi plays a crucial role in promoting financial inclusion by removing intermediaries and barriers to access. Traditional banking often requires extensive documentation and imposes high fees, making it difficult for low-income individuals to participate. DeFi platforms, on the other hand, are built on blockchain technology, enabling borderless and permissionless access to financial services. Additionally, DeFi applications offer a wide range of financial instruments, like lending, borrowing, and trading, without the need for a traditional bank account. This is especially beneficial for the unbanked and underbanked population, as they can now engage in financial activities and improve their economic well-being. Now, let's explore the benefits of DeFi for the final customer. One of the major advantages of DeFi is its accessibility. Customers can access DeFi platforms using just a smartphone and an internet connection. This opens up a world of financial opportunities for people across the globe, regardless of their location. Another significant benefit is the transparency and security that blockchain technology provides. Traditional financial systems can sometimes be opaque, leaving customers unsure about the safety of their funds. In contrast, DeFi operates on a decentralized and immutable ledger, ensuring trust and security. DeFi also introduced the concept of self-custody, where customers have full control over their assets through private keys. This reduces the risk of funds being held by a third party, enhancing the customer's autonomy and financial sovereignty. While DeFi brings many benefits, it's essential to address potential risks and challenges. DeFi is still a relatively young and evolving ecosystem. That is true. Smart contract vulnerabilities and bugs can pose risks, leading to financial losses. Customers need to be aware of this risk and exercise caution when interacting with DeFi protocols. Moreover, regulatory uncertainty remains a challenge for DeFi. Different jurisdictions have different approaches to cryptocurrencies and DeFi platforms, which can affect their adoption and growth. As we conclude our discussion, it's evident that DeFi has a profound impact on the inclusive finance community. By promoting financial inclusion, accessibility, transparency, and security, DeFi is empowering individuals worldwide to take control of their financial futures. Finally, remember, while DeFi brings exciting opportunities, it's crucial to stay informed and vigilant about the potential risks involved. Thank you for joining, and see you in the next Financial Inclusion Week.
Now we continue to the opposite point of view. Here, my colleague, professor and researcher Nuria Rojas will address the risk in DeFi. So let's hear it.
Although DeFi presents us with a unique value proposition, we are still in early days of adoption and development, so it comes with its own challenges. The DeFi sphere is still complicated and for the time being quite hard to use. The interaction process of protocols is not very intuitive, and some of them require some specialized skill sets. Most of the apps, protocols, and platforms were not developed based on what the users need, but rather on what is available to the developers. There are many aspects of DeFi products and transactions that the average participant does not understand. For a non-programmer, it is very difficult to interact with the interfaces of DeFi if one is not familiar with blockchain technology, given the technical complexity. Even when user-friendly web interfaces allow for an easier access to DeFi protocols, the average consumer of DeFi-based financial products is unable to fully grasp the underlying complexity of a disintermediated system. Open source code, while transparent, would not be sufficient for the average retail investor that does not have the requisite level of technological and financial literacy to understand the implicit risks. Technically, users will require a combination of coding skills and financial literacy in order to fully understand the mechanism of the protocol as well as the implications of the code on financial and other risks. Speaking about risks of DeFi for the financial customer, we can identify the following: execution risk in smart contracts, legal liability risk, data theft risk, interconnectedness risk, external data risk, greater propensity for illicit activity using DeFi applications, volatility risk, and regulatory uncertainty. Execution risk. Coding errors can create vulnerabilities that allow an attacker to make the code unusable, or create vulnerabilities that allow an attacker to steal the funds embedded in a smart financial contract. Legal liabilities risk is existent because the average user of technology who cannot read a smart contract code or evaluate its security can be misled into signing a compromised smart contract, thereby exposing the user to risk and enforcing legal liability. Data theft risk. Many decentralized finance protocols and applications use admin keys to operate the smart contract and to perform emergency shutdowns. If the key holders do not create or store their keys securely, malicious third parties can steal the keys and compromise the smart contract. Interconnectedness or dependency risk. This arises because decentralized finance protocols allows various smart contracts and decentralized blockchain applications to interact with each other to offer new services based on a combination of existing ones. These interactions introduce significant dependencies such that if there is an issue with one smart contract, it may have wide-reaching consequences for multiple decentralized finance applications across the entire decentralized finance ecosystem. External data risk. Many decentralized finance applications rely on external data. When a smart contract depends on data that are not available on the blockchain, the data will be provided by external data sources. There is high propensity for illicit activity when using decentralized finance application. The decentralized nature of decentralized finance systems makes it attractive for illicit activities. Actors with dishonest intentions can use decentralized finance applications to launder money and to fund criminal activities. Volatility risk. This is present because the collateral pledged in decentralized finance transactions are simply cryptocurrencies that already have a reputation for being volatile. The lack of traditional regulatory safeguards for investor protections leaves investors and financial consumers more exposed to forms of loss or erosion of value. Users have no recourse in case of default or failure of the DeFi protocol. And in most cases, it is also difficult to identify a responsible party or a central authority to turn to in case of consumer concerns.
In conclusion, it is crucial to understand that financial exclusion is a social problem that has persisted since the inception of the first financial system. The unbanked are trapped in a vicious cycle of poverty due to the lack of access of banking and financial infrastructures. Public policies and education on financial literacy and technology must be implemented to address these challenges. DeFi explores opportunities to provide financial services to the excluded population and break this cycle. It is imperative that we take action to put an end to financial exclusion and create a better world for humanity. Thank you for listening to us, and thank you for your time.